Good morning, everyone. My name is Sinead Fox-Hamilton. I'm a Relationship and Professional Development Manager here at Chartered Accountants Ireland, and it's my pleasure to be your host today and to welcome you to our session this morning on how should a long-term investment portfolio look today. So this is a special 1-hour webinar kindly sponsored and delivered by Acuvest, and I'm delighted to see so many of you tune in. Now, before we get into the main presentation, I'd just briefly touch on a few things. Agenda-wise, we have 2 expert speakers from Acuvest. They'll take us through the key content today. That'll take around 45 minutes, and then we have time at the end for Q&A where we can field any queries that you might have. So if you would like to submit a question at any time during the presentation, you can do that by selecting the Q&A button on the menu and then simply add your question. So that's at the bottom of your screen within the Zoom bar. Should you have any technical queries or any issues, please use then the chat function to communicate with our team behind the scenes. So let's get things underway. As I mentioned, today's session is presented by Acuvest, who are a privately owned independent Irish advisory business. And we have 2 reps joining us this morning, and we will be hearing from Damien Cooper, Head of Private Clients and Investments, and Chris Johns, Investment Committee Member. So I will stand in your way no more. I think that's enough for me, and I am delighted now to pass across to the gents. Over to you, Damien and Chris.
Thank you, Sinead, and thank you all for joining us here today for a discussion on the current investment environment and how we are advising our clients to build their portfolios in these challenging and uncertain times. Let me start with a brief introduction. Acuvest is an independent investment advisory firm. When we say that, we mean that the only thing that we sell our clients is our advice. We don't sell investment products. We don't earn commissions on any investments that our clients make. And this allows us to stay fully focused on helping our clients achieve their investment goals. We've been in business almost 20 years now, and the clients that we advise have assets approximating totaling about 4.5 billion. Apologies. These range from large institutions, pension schemes and charities to family offices and individuals. It's really important when you're investing to have confidence that your investments appropriately reflect current valuations and market conditions and are capable from benefiting from future opportunities. As investment advisors, this is a fundamental part of our job, and we invest considerable resources into doing this as well as we possibly can. Market views and current trends are also intellectually engaging and interesting to consider and discuss. So in a minute, I'm going to ask my fellow investment committee member, Chris Johns, to talk you through our views on markets. But it's vital to remember that nobody has a perfectly clear crystal ball. We cannot tell with the future with certainty. If we could, we'd probably buy winning lottery tickets and not worry too much about investments at all. What we can do, however, is put in place a really good investment management process to make sure that the investments that we do hold are appropriate for us and that they will help us to achieve our goals and objectives. So once Chris has shared our view of markets, I'm going to take you briefly through the way in which we're helping clients by developing investment strategies that are designed to achieve their objectives and cater for challenging market environments like the one we have at the moment. So Chris, how clear is the crystal ball?
Thanks very much, Damien, and good morning, everybody. How clear is the crystal ball? Well, people like me are very prone to say things like things are particularly uncertain at the moment. Indeed, I think I've used that phrase every time I've made a presentation like this over the course of a 30, 40-year career. But it happens to be true at the moment. Things are particularly murky. The pandemic has thrown a lot of things into the air, so things are much, much more uncertain. That crystal ball is a lot murkier than it is usually. The first thing I'm starting with here is the economic outlook, because that does drive everything that we're invested in. The economy is the thing that generates the returns that these portfolios that Damien has already mentioned reap rewards from for investors, for our clients, for our pension fund members, for us as individual savers. And it's the economy. It really is. And this is the slide of IMF, International Monetary Fund forecasts for the next year, and also an illustration of what we've just come through. It's three basic regions: the world economy as a whole, advanced economies, and emerging markets. And you can see the picture is basically the same. The numbers vary a little bit depending on which region we're looking at, but an absolutely horrible 2020 for very obvious pandemic related reasons. 2021 has been much, much better, and those growth numbers are really very high in any kind of historical context. 2022 is going to see lower growth than this year, according to the IMF and indeed most forecasters, but the numbers are still robust, and these numbers are still high, although they are going down a bit as the economy settles down. The first and most important thing I can tell you about these forecasts, apart from that basic story about the growth profile of the world economy, is that they're going to be wrong. These forecasts always are. Economic forecasts, if they're ever right, are right by accident, and no one economic forecaster is ever correct in a sustained way. Economists don't have the tools, techniques, spreadsheets, models that enable them to be able to consistently forecast well. So what we have to do is plan for a very uncertain future. So what we do is that we design portfolios that we think, we hope, we believe are robust to a range of potential economic outcomes. And when we talk about risk, because this is where we start to introduce risk management, and that is an important tool when building portfolios, economic risk is just one out of many that we face. At the moment, a contemporary risk is inflation. That's a form of economic risk, but it's not about growth, it's about prices, and I'll talk a little bit more about that. A key ingredient in any economic forecast, any analysis of the economy is always time, and that's important to investors in general as well, because the more you have of it in terms of investment horizon, the less you have to worry about these economic and other essentially short-term risks. Different investors have very different attitudes towards time. In some ways, all investors are unique in terms of their own investment horizon. Everybody's time horizon is different. We're all different ages. We all have different ambitions for our futures. And that's important to us at Acuvest, because we think that as well as not selling you product, we don't sell you the idea that one size fits all. Everybody's needs, desires, time horizons are different to the point of being unique. One of the things about time when we are devising portfolios is that we look at big data. We are very data driven. We always ask, what can we learn, for example, from the past in terms of thinking about the future? I love this chart because it's pretty stark. It tells a story that economic growth historically is a very recent phenomenon, but it also shows you how much economic growth since the Industrial Revolution there's been. There's been a lot of it. People are often surprised to learn how little there was globally for a very long period of time before the Industrial Revolution. But when you look at charts like this, when you start thinking about growth, economic growth, and its relationship to investment returns, the question naturally arises, well, if my time horizon is that important, how long is long enough? If investment advisors like you, Chris, are saying, okay, wait long enough and the investment returns will come, and don't worry too much about the short term, those are words that you often hear people like me use, how long is enough? Well, there are various ways of answering that question, and it's very important as a building block for these portfolios that we do end up recommending to our clients. This is a busy chart, and it's worth spending a minute on to explain it to you, because it does explicitly answer that question, at least historically, how long is enough? This looks at the US equity market. We often begin our analysis with US equities because it is the biggest equity market in the world. It's nearly 60% of total equity market valuation around the world, and other equity markets, that other 40% or so, often takes its lead from what happens in the US. So you'll find people like me and Damien often starting the discussion at least with what's going on in America. This looks at over a century of returns from US equities, and it begins by saying, okay, let's look at a 10-year investment horizon, of which over the last 130 years for which we have the data, there have been lots of 10-year periods. And let's look at what you would have gained if you just simply bought and held the broad basket of US equities, the whole market. And there were 10-year periods for US equities where you would have got -5%. There are 10-year periods where you would have got +15, 16%. That's that left-hand very wide range in the chart. As the time period is increased, as we move rightwards through this chart, as our holding period is increased, you'll see that return spread dispersion becomes more compressed. And what the data tells you is that historically, at least, there was one 16-year period where US equities, if you'd held them for that 16-year period, would have lost you money, but there wasn't in history a 17-year period. So the answer for the US equity market, if the future is like the past exactly, and that's a big if, that the longest you'll have to wait for a positive real return from holding equities is 17 years. Now, when we talk about time horizon, a lot of people balk at this point, say, well, that's a blooming long time horizon, isn't it? And the answer is yes, it is. To be sure of investment returns, you do have to wait a long time. And people are surprised by the conclusion that I've just posited there, because most people are sold time horizons by certain people in financial markets that are often a lot shorter than that. But the reason why we don't recommend 100% equity portfolios for people with shorter time horizons is simply because of that dispersion of returns. The reason why we build portfolios is because people often have shorter time horizons, different risk profiles. And remember that the US equity market historically is the best. If you other equity markets, you would have had to wait even longer. The only protection for building a portfolio, as Damien has already hinted, is the perfect crystal ball, this perfect foresight, in which case you wouldn't need a portfolio, you just buy the best asset. So our portfolio choices always reflect our beliefs and views about things like the economy, but also other things. We are also acutely aware that our beliefs and forecasts are almost always going to be wrong. That leads to a cliche in financial markets that happens to be true. It's a very good cliche. The only free lunch, your only real true friend in financial markets is diversification. The sense in which markets can do anything to you in the short term, I've talked a lot about long-term data there, is best exemplified by this chart, which takes us through equities, bonds, and commodities over the past couple of years. And this is certainly the environment we've been in has been very familiar to all of us. You can see that when the pandemic hit at the February, March of beginning 2020, equities and commodities took a big dive, bond markets not so much. One of the things that happened during that period was that a lot of people panicked. A lot of very professional investors panicked. People I know who should have known better sold immediately the news of the pandemic hit. They got out of equities, or they sold a lot of their equities, which, as it turns out, was exactly the wrong thing to do. One of the key, I think, attributes of an advisor like Acuvest is the hand-holding that goes on during these sorts of times. And often the right advice is just to sit there and do nothing. And it certainly was the right advice during this period of time, because you can see very quickly, almost overnight, mostly thanks to what was happening in terms of economic policy, monetary and fiscal stimulus, equity markets began to recover. And they slowly recovered through 2020 to the point in the autumn when the big uplift came, when the vaccine announcement came, almost exactly a year ago to the day. And equities have been on, certainly US equities in particular, but also others have been on a tear ever since. Markets can do anything to you in the short term. A lot of what I've just described over the last 2 years would have been impossible to forecast, and indeed nobody did forecast it. In terms of the raw numbers across a number of asset classes, you can see that it's been a good time to be invested in what we call real assets, things like equities, property. Not so good for being a bond investor for fixed income. Bonds have been a great investment for many years, but not so much recently. Government bonds, corporate bonds are the ones with the minus numbers in front of them there. One of the ways in which we start to build portfolios, apart from looking at the overall economic environment, is we start to look at how various assets, asset classes, and individual assets within those classes are actually valued. We'd have a belief that your expected returns, which are a very important, again, building block for portfolio management, are to a considerable extent, not entirely, determined by the starting valuation point. of the assets that we're investing in. And we slice and dice the data in various ways. What the chart on the left shows is the cheapest equity market in the world at the moment, certainly major equity market, is actually the British one, the UK equity market, when we measure it via things like dividend yields, but also lots of other valuation metrics, price earnings ratios, and all the things that people like me speak about. The UK equity market is amazingly cheap. And the debate that asset allocators, portfolio builders have when they observe that kind of cheap asset is that we ask, is it cheap for a good reason, or is it just cheap because it's just cheap and that it's a valuation anomaly that over some unknown time period is likely to be arbitraged away, and therefore is a good buying opportunity? And that's the debate, particularly about the UK, but also the way in which we slice and dice other aspects of the global equity market as well. Emerging markets as well are very, very cheap at the moment. And that's the kind of debate that we have once we've sorted out our economic outlook. The chart on the right looks at the various ways in which investors class themselves in terms of their style investing. You may have heard people describe themselves as pure value investors. You may have heard the words growth investors. It's been a happy place to be a growth investor, which has led you to buy markets like the US, and in particular stocks, equities like Facebook, Amazon, Netflix, Microsoft, Apple, Google. Those sorts of stocks have been doing very well, and they are the growth numbers that you see in this chart here. It's been miserable over the shorter term at least, and indeed over the medium term, to have been a pure value investor. We are neither. We don't have a particular, we are not wedded unthinkingly to one particular style. We look at all of these things in the round. Bonds are another incredibly important building block for portfolios for two reasons. One, they are things that we invest in their own right, for their own attributes. Often, a lot of clients have to invest in bonds for regulatory reasons, for legal reasons, or just for risk management reasons. But bonds also end up determining the price of everything else. All of the things that all the tools that we use to ask the question, is an asset fairly valued or not, ultimately have a bond yield lurking somewhere in the formula, the models, the spreadsheets that we use. So the reason why people like me talk about bonds incessantly is twofold. They are incredibly important. And here you can see over the last couple of years, bond yields have gone up and down, but they haven't actually done very much. They are historically, in many countries, very, very low. In the Eurozone, they're actually negative in some cases, which is and remains a big puzzle. The pandemic is part of that story, it's part of the equity market valuation story, it's part of the economic growth story. And we can see that on the left-hand side, what's been happening recently. These charts change around a lot. For example, the UK numbers in that chart show them coming down. Over the last few days, they've been going back up again. The Irish numbers, unfortunately, are going up a lot, as we know, as we see from our daily newspapers and news reports. Even the US is starting to go up again. The right-hand side makes the point that hospitalizations, thankfully, are not following these numbers up to quite the same extent. And we now think that the pandemic is in the process of becoming endemic. We're going to be talking about it for a long period of time, but hopefully not in the way that we have been. The key debate in financial markets at the moment for that short-term outlook is what is happening to inflation. And the raw numbers are scary. US inflation at the moment, the most recent print was 6.2%. You can see that in the chart on the left, and it hasn't been that high since the early 1990s. That sparked a debate about whether or not interest rates are going to have to rise. It looks like the country where interest rates are going to rise first is going to be the United Kingdom. That's all to do with the behavior of particular central banks and their attitude towards inflation. Inflation is not as big a problem in the UK as it is in the US, but the UK seem to be leading the charge on interest rates. The US will probably not go until next year, we don't think. That might change given the scale of the problem. Rising interest rates are not a good thing generally, particularly for a world that has an awful lot of debt. And we know that there has been an awful lot of borrowing recently, and that's why we worry so much about the inflation, interest rate, and therefore bond yield outlook. One of the things that should worry us closer to home is the chart on the right-hand side. Germany hasn't had its current inflation rate since they gave up the Deutschmark. And in that inflation-phobic country, that will be a concern for the European Central Bank. And this again is something that inputs into our short-term decision making. So the great debate is whether inflation is transitory or not. The answer is it's not transitory. It's already lasted a lot longer than people think. And the debate now is when interest rates are likely to rise in the various regions that we look at. There's too much focus, in my opinion, on the 1970s. The 1970s was a period where there was high inflation and very little economic growth. The problem we got at the moment is actually we've got a lot of economic growth and a lot of inflation. So it's not the 1970s stagflation. When it comes to inflation, it's very important to put it into the portfolio mix. And one of the things I have to tell you, and Damien will probably touch on this as well, is that there are few very good inflation hedges in the portfolio. Commodities are an obvious example of something that can be used carefully as an inflation hedge. Equities will beat inflation historically, but will not do very well in the short term. So we say that equities will protect you against inflation over the longer term, that point about time again, but in the short term, they're not a great actually hedge. I mentioned earlier on expected returns. This is an example of a set of expected returns from JP Morgan. And they are fairly typical of the way proper investors think about the future. And you can see all of the various asset classes that we will invest your clients' money in on the left-hand side. The diamonds are the historic returns, what those various asset buckets, asset classes have achieved historically. And the horizontal bars are what this entity, JP Morgan, thinks over the coming 10 to 15 years, the annualized returns on those asset classes will be. The first thing to note is that JP Morgan expect all the asset returns to be positive. That's a forecast. Remember what I said about forecasts. The most important thing about this chart is that the returns are all to the left of the diamonds. So this asset manager, we think quite correctly, is saying that asset returns are going to be lower, typically, sometimes much lower over the future than they have historically. In some ways, it's a chart that says the easy money has been made. It's another cliche that happens to be opposite. So that's me. I'm going to hand you back to Damien now, and he'll talk to you through about how that actually works through into real portfolios.
Okay, well, thanks, Chris. And I suppose the message really that we're coming to, and the conclusions we're coming to at our investment committee, and as we continue to look at markets, is markets continue to be complex. The outlook appears particularly complex at the moment. As Chris alluded to, it always seems to be more challenging. It's not an unusual one to feel more uncertain now. The future is always filled with more uncertainty than the past. But I suppose the fact that we don't know so much about the future, or there's much that we don't know about the future, is exactly the reason why we believe that investments need to be managed carefully. They need to be capable of being able to respond to changing circumstances as required. When deciding how to invest your money, you need to make sure that we at least can take account of the things we do know about you, about your clients, about your objectives, so that we can use these as a basis for our advice and the decisions that we need to take. Many of our clients, are primarily focused on working hard. Many of them have financial and investment expertise, but their day job is another expertise, and that's what they focus on, rightly so, because in terms of their personal capital, they can get the best return on that by managing what they're supposed to be doing. So what we do then is, what we provide is our investment and professional capital to sit alongside their personal capital, and to help them manage their accumulated wealth, and make sure that it's going in the right direction for them. I suppose it is our job to help clients take a step back and think about, who are they? What's the context for an investment decision? Because there's no such thing as a best investment or a worst investment for everybody. We need to make sure that we have a sense of who the investor is, where they are at the moment, where they're trying to get to. What are they trying to achieve? We then apply, obviously, our knowledge of investment markets, our relationships with the best fund managers in the world, to help them decide what sort of investments they should have in their portfolio, and then to oversee that, so that we can, as the saying goes, rinse, recycle, repeat, so that we can manage it and amend it over time, and make sure then we make assumptions, we make priorities, we set goals, we design something that's capable of achieving those goals, we implement it, we oversee it, and then we recycle, because periodically the world has changed, people's worlds, people's objectives, companies' worlds, companies' objectives, and investment markets are changing all the time. So it's very important to do that. And I've set out here just a quick overview of the process that we believe is very important, and that sits as a fundamental starting point behind every investment decision and every investment advice that we give. In terms of, I suppose the key questions, like investments are very important to our clients. People or companies, they are a precious resource. People have worked hard to accumulate them, and we naturally want them then to work hard for us. But again, as I alluded to earlier on, much as there isn't any such thing as, say, the best house for a person, some people like the idea of a luxury pad in a city centre, some people want to live on a farm in the country, and some people want to have a holiday home by the sea. There is no such thing as a best house for a person, but there is a best house for an individual person. So we need to think about it and to be able to get an understanding of, what are you trying to achieve with your objectives? What do you need to achieve from those objectives? What do you need to avoid? What risks can you not tolerate? What losses can you not cope with? The fundamental underpinning question is what is my time horizon? As Chris alluded to earlier on, how long do I have? Do I need this to achieve something within a year? Do I need it to achieve something in 5 years? Or is this something that I don't need for maybe 15, 20, 30 years, in which case this informs the investment risk that I can afford to take, the investment risk that's wise for me to take. And that's a key input. Again, as we have the constant debate and discussion ourselves in terms of discussions with clients and thinking about clients' objectives, people believe they have a time horizon, and lots of people believe they are long-term objectives until actually, as to use a Mike Tyson, until they get hit by a punch in the face in the short term, and then suddenly what they need actually is to be reminded of what their objectives were and what their time horizon were, and make sure that we have, as advisors, it's not our job to make sure that people don't suffer losses. It's our job to make sure that the experiences that they have are in line with their expectations, and that we have prepared them for that, and that we haven't led them down a path to somewhere that they can't afford to be. And that's our real job, and that's a real value add. The other important things that we need to think about is, what assets do I have at the moment? What do I have at my disposal? Do I have assets within my portfolio that don't need to be managed by an advisor? Things like investments in a private company. Maybe I've got some investment properties, some things that I need to hang on to, that I want to have there. Maybe I have a range of different investment objectives. Maybe I have some money that I would like to, if I'm a company, I've got some short-term needs, and therefore I need, but I've got some stuff that I've got a 2 to 3 year horizon for, and then I've got some longer-term stuff. If I'm a person, maybe I have, some pension money that I'm looking for retirement, and maybe I have a shorter-term objective that I need to save for kids' deposits for houses, or kids' college fees or school fees in a number of years' time. And they have different time horizons and different objectives, so we may need different pots. What we tend to also look at is to say, what are the what ifs that people need to look at? So what are the scenarios that people either need to avoid or that they need to maybe cater for? So what are the things that, we're on a journey with our clients, and we're trying to get to a long-term objective, but what are the things that might lead them to take a diversion along the path? Maybe if me or my partner want to retire early, or want to make a big trip, or you've got potentially maybe some health issues that may need to be addressed at different stages. So what are the what ifs that we need to cater for? And we build that into the plan, and then we try to build then a policy statement for someone, an investment policy statement, stating what our current objectives are, what our current beliefs are, and what we're trying to achieve. And what that does for people is that it gives them an anchor, and that is, that's a vital asset that someone has. They have reassurance that they have a plan. They know why they are where they are, and they have a sense of where they're going to go. You don't need to be able to tell the future, but that doesn't mean you shouldn't have a plan to help you along the way and something to help you back. And so that's one of the key, I suppose, people come to us for investment advice, but one of the key values that they get from having an investment advisor is that someone is on their side and has developed and helped them have a sense of where they are, where they're trying to get to, and it's a bounce of expertise that they can go back to if and when things change. When we come to actually building a portfolio, as Chris said, what we think about is the asset classes. There are a range of different asset classes and a range of different investments that are available for clients to invest in, and that have different attributes. And when we're thinking about building a portfolio, the way we think about it is, what characteristics are we hoping that these assets will have for our clients? So we're talking about a combination of maybe growth assets. So we're looking for high growth. So we invest in things like equities, property, those sorts of assets that are probably going to have deliver high growth over the long term, but may exhibit some volatility on that way. Do we need to have a mix of defensive assets in the portfolio, such as cash? Sometimes it will be things like core government bonds, albeit less so at the moment when they're probably a little bit less valuable, a little bit more expensive and a little bit higher risk. And then we have in between assets, things like that are investment grade corporate bonds, high yield debt. So again, things that have varying degrees of risk. They're not quite as risky as our equities, which are up on the top right hand corner of this chart, and they're going to generate more growth than our safe assets. So we need to think about that, and any investment portfolio that we build for our clients is likely to have an element of each of these pots, I suppose, what we call the building blocks. And the degree to which they will have those will depend on their individual objectives and their risk tolerance and their time horizon. So they're the things that build that, whether they've got maybe 80% growth assets and maybe a mix of 10 or 10% of other assets, or maybe they only have 40 or 30% of growth assets. So we build a portfolio based on people's needs. The other thing that we believe is very important in the portfolio construction process is that it needs to be bespoke, and it needs to reflect somebody's individual circumstances. We are not a mass producer of product. We don't sell investment products, and therefore we don't need our clients' portfolios to fit into a little basket. They don't need to be a cookie cutter. What we do is we look at what are their objectives, what are the beliefs they have. Maybe they don't like certain types of investments, things like ESG, environmental impact, things like that. Do they need to build those in? Maybe not. Maybe they do, but we're capable of tailoring things for that. We obviously build in our investment expertise and our views on markets, which, I've got an example growth portfolio down on the bottom left-hand corner here, and that would be what we look at as an investment committee. We periodically, we meet quarterly formally, and we meet in between times as markets demand, I suppose, as market circumstances demand. And we keep an eye on that. But what we end up with building is on the right-hand side, a portfolio for a client. And as you can see here, one of the things that's in there is, in that red bucket here that's on the left-hand side of that portfolio, they're all growth assets. But in this client portfolio example that I've got here, we've carved out a corner piece here for this client who has their own growth assets. So they have an allocation potentially to an investment property, or they have an investment, private equity investments that they've, a family business or things like that. And again, sometimes in people's safe assets. So what we do is we build that into our investment construction process for clients. And we have that architect's plan, and then we look at the different pieces that people are going to use. Maybe I'll go back to current market views, and I'll bring Chris back in here as well, really to talk about our current views of those asset classes. Chris.
Yeah, well, you can probably gather from what I was saying here is that over the long haul, going back to that point about time, the asset of choice will always be equities. But because not everybody, indeed very few people, have that long-term horizon, you really have to be somebody in your 20s saving for your pension to have that kind of 100% equity portfolio. We think about the shorter term the people that need portfolios rather than putting all your eggs into one basket. We're quite neutral about many things relative to the portfolio benchmark that we will construct for you, so that we are conscious that in equities, for example, as I said earlier on, the easy money in a sense has been made. Going back to that US equity market, in March 2009, the S&P 500, which is a measure, an index number for the US equity market, bottomed out at the time of the great financial crisis at 666. And it's currently at around 4,500. That's been one heck of a ride, which has taken that market, we worry sometimes, into straying into expensive territory. That said, it is a growth market, as Damien and I have mentioned, so we have an allocation to equities that we describe as neutral. To the extent that this is a high growth environment, and you heard me mention that it isn't stagflation at the moment, and certainly where we are today and where we're likely to be on the sort of forecasts that I put in front of you, growth is definitely out there. We do have a high growth world economy. It isn't the 1970s, which was low growth and high inflation. This is high growth with that worry about high inflation. So we have an allocation to something called other real assets. And there are various things in here, but one such would be something like infrastructure investment, which I know is quite popular, but I think is popular for good reasons. The asset classes that we are far less convinced about, as both Damien and I have mentioned, have been bonds, fixed income securities, in particular ones that are nominal, that are non-index linked, if you like. As you'll notice, there is a difference in allocation between index linked and other more conventional types of bonds. Inflation is a big negative for conventional fixed income securities. And because inflation is already a bigger problem than we thought, in some ways, the puzzle is why government bond prices haven't fallen further than they have, but we do think that they are likely to suffer. So we are negative on fixed income securities.
I think it's important to just remind people that I suppose when we talk about our neutral view, we do have an expectation that equities and growth assets will deliver returns, as I showed on this slide here. So those return-seeking assets, we expect them to have stronger returns, and for people that are looking for high returns, we have high allocations to those as part of their neutral portfolio. When we talk about these views, it's views relative to long-term expectations. So we expect equities always to give you stronger returns than bonds or cash, and therefore we make the allocation in that context. I suppose the neutral allocation at the moment is saying, well, that we don't expect necessarily the return, the excess returns that they will generate to be that they were on a risk-adjusted basis. We don't expect that there's a massive opportunity for them to be bumper like they have been for the last few years, 18-20% per annum returns. If you look at equity market valuations at the moment, they are very high, obviously underpinned by those very low bond yields and all the QE and stimulus activity that's been going on. And so we definitely have a natural bias to those assets for generating growth, but at the moment we are neutral to that bias over the long term. In terms of, we'll just jump on maybe to what that means for client portfolios right now. And so what we are advising people at the moment, we are advising people that the current environment, I suppose, is unprecedented. We've never seen the degree of stimulus that has been injected into markets and economies over the last few years. It has never happened before. In the past, one would have expected that excessive stimulus and printing of money that we've seen would lead to high inflation. In the aftermath of the global financial crisis, that did not happen, and that was a surprise to markets. It is now starting to happen here, and so that we are seeing that inflation has increased significantly. Is it the degree to which it will stay at those high levels is under review. I suppose our belief is that it may very well be higher than what central banks are talking about it, and that they have a natural bias actually to encourage higher inflation at the moment. but they also have a natural bias to play it down so that it doesn't become endemic and doesn't lead them to have to raise interest rates. We believe in this environment where we do have COVID and the uncertainty of I suppose emergence from lockdown and how that is happening in an uneven manner across the world and in a stop-start manner in most countries, unfortunately, that we are going to see volatility. We're going to see higher volatility than we have in the past. As Chris said, interest rates are key because I suppose the cost of money is just dictated by interest rates. And if I have a high cost of money, well, then I need to generate a high return on my capital. If I have a low cost of money, then I don't need to generate as much of a return on my capital. That is one of the issues that's been driving equity markets because I have a low cost of money and therefore I can invest money in high growth stocks that aren't necessarily particularly profitable now in the expectation that they might be profitable in the future, and I can wait because it's not costing me anything to have that investment on hold. So interest rates and what happens to them is very key, and it's something that we are keeping a close eye on. But I suppose from our perspective in the current environment, given the risk return profile that is out there, steady as she goes, that old nautical phrase, the importance is to have a plan, to have a strategy that is capable of achieving your investment objectives. Have the plan and stick to it unless you have a very strong reason to deviate from it, and that's okay. So then if you have a reason, then you're doing things for a reason. That is quite all right. If you have cash at the moment, what we'd be saying is you still develop your plan, but you don't necessarily jump into it right now. So some of our clients come into us and they have cash and they have objectives and they've just liquidated something. And so we're saying, well, over the long term, this is the portfolio you'd be in, but you should average into that given the volatility that's out there at the moment. And that gives you the opportunity to potentially take advantage of setbacks in markets, and the old adage of buying low being your best investment is very pertinent at the moment. In terms of when you're thinking about how you should be managing your own portfolio and what you need to keep an eye on, really, all the time, it needs to be, is the portfolio construction process there? You need to think about your objectives. You need to make sure that you or your clients have thought about what you're trying to achieve, and that what you're getting is something that's tailored and capable of achieving those objectives. If you don't do that, it's akin to walking into the supermarket thinking, I need food. You'll probably get whatever is on offer at the time or whatever someone wants to sell you, as opposed to necessarily something that you actually want for your dinner, or you want that's best for you for the long term. Again, when you're looking at your investments, make sure that you watch out for your own constraints, your own inherent biases. Watch out for conflicts of interest. Obviously, someone providing you with free advice might be your best friend, but there's very few people work for free, and therefore this is important. You need to get it right, and therefore you need to make sure that you do it properly. Again, from our perspective, you need to have a degree of active management, especially in the current environment. It allows you to consider whether or not the next best thing is a good thing for you, or whether it's the next tulip bubble. And then, of course, especially in a low interest rate environment, costs and fees and charges are even more important than they normally are, albeit they are always important. The quota they have at the end is one of our underlying philosophies when we're helping clients. Is that investments are difficult, they are complex, there's a lot in it, there's a lot of work goes on. That's our job, to do that work. An investor should always understand what they have and why they have it. As Albert Einstein said, they should be simple. You should be able to understand it. It's not necessarily to say that it's all needs to be A's, B, ABCs. So I just I leave it at that. So I'd like to welcome any questions maybe that you have.
Gents, thank you so much. You have covered a lot of ground there, and we really appreciate you sharing your expertise and insights. And it is no surprise that we have some questions. And folks, Should any questions still be burning on your side, please pop them in the Q&A box at the bottom of your Zoom screen. So let's get stuck into a few questions, gents. If I pose the first one to you, then how do Acuvest manage risks associated with investing cash lump sums for clients in current markets? For example, say a cash lump sum at retirement.
Yeah, and then that's a very good question, Sinead, and it's one, as I briefly alluded to at the end there, it's like really, it depends on your circumstances and it depends on your time horizon. But what the first thing is to not jump, not to, we try to advise clients not to avoid knee-jerk reactions, to make sure that they have thought about why they're going to do something, what they're trying to achieve with it. Again, do you have a plan? Do you have a medium-term objective? Do you have a longer-term objective? And then what's a sensible way of getting there over time? Really, from our perspective at the moment, we are advising clients to phase into markets with large lump sums. But again, it would depend on the context of that and how that sits alongside your other assets. So it's about the purpose in the portfolio. Some people's cash lump sum, for example, at retirement is really a proxy for their salary until maybe they start drawing a state pension, and therefore investing that in any sort of risky asset is something that we wouldn't advise. It's something that we would advise make sure you think very carefully about before you do.
Great, thank you, Damien. And if I move on to another one here, should clients be considering ESG investments at present? So very topical.
Yeah, and yes, they absolutely should, but I suppose to the extent that it is important to them, depending on you as a client. If you are a pension fund, you'll be all over ESG because the recent IORPS regulations are requiring you to take account of it and to build that into your investment portfolio. ESG is one of these areas. I suppose it's been growing in popularity and importance over the last number of years. It's a trend that is likely to continue. In terms of, I would be very wary of buying ESG investments because many of them are labeled as ESG friendly, and so you need to make sure that you have an understanding of what way they are complying with different objectives, and does that align with your own personal views and opinions. So a lot of our clients, again, as I said, institutional clients, have already been building this into their investment decision-making process. Many other of our clients are saying, yes, I do have, I do want my, I want my investments to benefit the environment or at least do no harm, and therefore you need to think about moving towards that over time. But you need to think about, I suppose, consequences of every action, and make sure that you're not bringing inherent bias and unintended consequences when you're doing it. A lot of the products are new and untested, and some of them are expensive at the moment.
Thanks, Damien. And another one we have here: when designing an investment portfolio, how do you choose the investments that will be included in the portfolio?
Yeah, well, I'll take that one again. And I suppose really we are an institutional investment advisor and have been in the market for the last 20 years. And so we have relationships with and working relationships with most of the large global fund managers that are operating and making products available in the Irish marketplace. We've been looking at these clients and these managers for years, but we are completely unbiased. I suppose we have access to all of the fund managers in the world, and all the leading fund managers in the world. And so what we tend to do is we look at what are we trying to achieve when we're looking for an investment, and then what way can we access that investment in a simple and good value manner? Are there easy ways of accessing it? So if our default investment, if you're looking to go into equities, would be to have at least a big chunk of that money invested passively, because you know what you're getting. It's going to give you the market exposure and it's low cost. If you're looking to then move towards thematic investments, then there are additional things that you look at. So we look across the range of uniforms on using a range of platforms. I suppose we work with all the insurance platforms and then independent brokerage platforms as well.
Great, thank you, Damien. Another one for you here. Can you elaborate on the other real asset category and reference to their strategic development investment? Is there any examples there?
Yeah, well, the other asset category would be things like what Chris alluded to, things like infrastructure, private equity, other illiquid assets. We take them into consideration. We do research on them at investment committee level. We keep an eye on them. We have a view on these assets. They're not for everybody. Everybody doesn't have the capability to go into them because sometimes people don't have the investment horizon, the long-term time horizon that they need to go into things that are illiquid. But again, we keep we keep major asset classes under review and maintain our view of them and like to have diversification in portfolios where we can at all.
Super, thank you. Another one then, with banks offering zero to negative interest on deposits for the foreseeable future, are there any alternatives at present for clients then?
No is the short answer.
Yeah, and that's the challenge at the moment, and I suppose that's the environment, that's the context, and so that's why it's important to think about the purpose that you have those assets for. So if you're holding cash, why are you holding cash? Are you holding cash to give you liquidity? Are you holding it for defensive reasons? If you're looking for defensive reasons, what we've seen recently, we've seen some clients with very long investment horizons actually making allocations to real assets such as maybe property or infrastructure or things like that that they can say, well, actually, here's a direct property portfolio. I'm happy to buy this property and it will give me a rental yield, and therefore that'll do me as a bond substitute. Now, obviously, there are risks and investment considerations that need to be taken on board. Under a traditional method, we would consider property to be a growth asset, and therefore, and because it can be very volatile and illiquid. But people, for stuff that needs to be liquid, you need to recognize that in a negative interest rate environment, essentially, you need to be paying, there is a cost of insurance. So if you're holding something for safety, well, then you're paying insurance. So you need to have that, and that's the environment that we're in at the moment. And so obviously minimizing it, being aware of it. There are, for individual clients, there are cash instruments that are out there that are not generating negative rates. Obviously, depending on the size and scale of your investment, some of the banks are charging negative interest rates on deposits above certain thresholds, but individuals have the ability to maybe use national savings certificates, diversifying between banks, and short-term bond type instruments is something that we look at where you've got actively managed things, but these are depending on the purpose that you're holding it. So it is very much dependent on why you're holding it.
There are a few more. We'll do our best to get through them, Jen. So another one, in terms of averaging into the market with a cash lump sum that is not required for, say, 5 to 7 years, is there any rule of thumb you can give for how slowly or quickly the funds should be fed into a portfolio in the current climate?
No is the easy answer. So no, there isn't a rule of thumb, and there isn't a right answer. So I suppose what we would do, how we would approach that question with clients, or how we do approach that question with clients, is try to get to what is the right answer for them. So it very much comes back to how big a proportion of your portfolio is this lump sum? How much? How important is it to your achieving your objectives over time? Do you have time on your side? Do you need to be getting returns on it over the short to medium term? And that's really the context. But certainly, we would advise. I suppose what we're trying to do is, in the absence of perfect foresight, we're trying to make sure that we're avoiding regret or minimizing our chance of regret. And really, what we're looking at is saying, well, at least I've made an informed decision that I know that if I delay this, I may have an opportunity cost because I haven't had it invested and the assets might go up. Is that something that I'm more or less happy with than if I did invest it all and I have a loss and experience a loss over the short term? And that's the balance that needs to be struck. And it's an individual, I suppose the answers are individual and bespoke to client circumstances.
Sure, it's not a case of no one size fits all. Absolutely.
No.
Another one for you, gents. Do you develop personalized portfolios for self-administered pensions?
And the answer, again, the easy answer is absolutely. That is our job. And when we look at client circumstances, we develop personalized portfolios for all of our clients, and that is our job. That's what we try and do. And so absolutely, we self-administered pensions is something that forms part of a lot of people's investment portfolios. Again, what we try and look at is, you have these investments, this is your strategy. You will probably have then a number of different buckets or wrappers that you will have. You have some of your savings in a tax wrapper called a pension scheme. You have some of them maybe tied up in investment properties or things like that, and maybe in a business, and then you have some liquid investments that you need to think of. And so you think about them all and build them all into your strategy.
I think we have time for one more. So should people consider including allocations to cryptocurrencies such as Bitcoin in their portfolio as a hedge against inflation or weakness in traditional currencies like US dollar, euro?
Well, cryptocurrency is a very interesting one, and I could certainly give you a view, but Chris, I think I might let you take that one.
Yeah. Well, first of all, I'll give you my personal view as opposed to a house view, and luckily the personal view is harder and firmer than any house view that is likely to be. I have a firm belief that you should only invest in things that you have a decent understanding of. You don't need to have a detailed soup to nuts understanding of everything that every asset manager, every asset is doing. But I've no idea what crypto is and what it does. I've looked at it, I've researched it. It makes no sense to me. So therefore, I don't personally invest it, and I don't personally recommend it to anybody. That said, it's almost inevitable that the possibility of you ultimately owning some crypto is there by the various buckets that anybody invests in. This isn't necessarily just what Acuvest clients end up with, but if you are, for example, as many of our clients are, invested with multi-asset, what we call real return funds, which are, if you like, lower volatility, lower risk hedge fund type products, which are an attempt to capture the idea that it's very difficult. Cash is somewhere where you don't want to be at the moment in this high inflation, low interest rate, low bond yield environment, but equities offer too much risk over the short term. So there are buckets out there called real return multi-asset class managers, where some of our clients are invested, and one or two of them from time to time might invest in crypto. Indeed, I know that one of them has, and that raises questions with individual clients about whether that's what they want, whether that's what they desire, and that's the right way to do it. But always to be aware of what your asset manager is likely to invest in. If you say, I don't want to be an ESG investor, or I don't want to be a crypto investor, that's important to establish at the beginning, to know what it is, therefore, that the various buckets that you go into. So yes, lots of people are investing in crypto. Lots of people are. It's not something I like. It's not something I understand. So therefore, it is something that I would avoid.
Over the medium term, there's possibility, I think, that cryptocurrency or blockchain technology, at least, that underpins it, is, it's possibility that it will form the future of investment portfolios into the future. But I think at the moment, it has an element of, it's very highly volatile. It's a punt at the moment, I would think. So we would tend to, if people are making an investment in a punt, they know they're making an investment in a punt, and it's for a good reason, as opposed to a core safe asset.
Well, gents, thank you so much. In the interest of time, that is a wrap on today's session. Thank you again to Acuvest for sponsoring and delivering today's content, and the fantastic speakers, both Damien and Chris, for sharing all your expertise and insights. Hugely valuable session for our members, and we really appreciate your partnership today, so thank you. And thanks also to all those involved behind the scenes, including even from our own side, Paul, who's in the wings looking after the tech side. Thank you everyone for tuning in and joining us. I hope you find the session really interesting, got a lot from it, and I hope we can continue to welcome you to future Institute events. Just very quickly in that vein, I'll just mention briefly, our full programme of CPD activity is available online on the website if you want to explore other training, other events. I know as we approach the end of the year, everyone is keen to get their CPD hours in, and our winter programme is very much live, and there's a full range of offerings, so check out the website. If you have any questions on today's event on CPD, please reach out at cpd@charteredaccountants.ie. And that is all then from us today, folks. Thank you again, everyone. Have a great afternoon and take care, and bye for now.